Welcome. This is Zach Smith at Chariot Financial, coming to you live from Chariot Financial headquarters here in Lakewood, Colorado. And we're here to talk about the reverse mortgage program as we do every week. Welcome, everybody. My name is Zach Smith. I am the owner of Chariot Financial. Been in the mortgage and real estate industry for 21 years. And I'm here to present some information about the reverse mortgage, as I mentioned earlier, as we do every week. So let's go ahead and dive into it here. So again, I've been in the mortgage industry for 21 years. I've been voted as a five-star professional since 2018. Certified senior advisor. Also, I'm a wholesale mortgage broker, which most people who originate reverse mortgage loans are brokers. You can't go generally into a bank and walk in and get one of these programs. These are more of a specialized type niche program. So you want to work with a good broker to move things forward with that. So who qualifies for a reverse mortgage? Well, you have to be 62 or better, 55 in some cases. So we do have some programs that are available for folks who are 55 plus. Also, must be your primary residence. So you have to live there at least 6 months in a year. And when you file your taxes, it has to show that that's your primary residence. FHA programs are the most common, and they also offer the best terms. Well, depending on how you're looking at it. One of the things that people don't like about this program is that there's an upfront mortgage insurance premium that's on every FHA loan. Now, that's not just the reverse mortgage. That's also for loans. Let's say we have somebody who's a first-time home buyer or who wants to take advantage of maybe a little bit lower rate these days. That same upfront mortgage insurance premium, it's not the exact same, but it's very, very similar, is on those loans as well. One of the things that the reverse mortgage has got a bad rap for is the high closing costs. Everybody points, oh, there's high closing costs. And then they point to, well, it's a program designed for seniors. Well, it must be a bad idea. You got high closing costs and then it's a program for seniors. Like, what are you guys trying to do? Well, the thing is that again, those closing costs in regards to the upfront mortgage insurance premium, if you're, getting a normal FHA loan, not even a reverse mortgage, you still have those costs. So the upfront mortgage insurance premium is not a reverse mortgage thing. It's more of an FHA type thing. But I think it makes it's more like clickbait, if they say, oh, it's part of the reverse mortgage. So the reason I bring that up is that the programs that are 55 plus, the proprietary programs, like for someone, all condo complexes need to be approved by FHA if FHA will fund a loan in that subdivision. So what if it's not approved? Well, we can look at some of those programs. Now, those programs have higher interest rates than the FHA program, but the advantage that you have with those programs is that there's no upfront mortgage insurance premium. So, and if you're wondering what that is, it's 2% of the property value. So it is a pretty steep fee. $500,000 home is 10 grand that they'll charge you at closing. Now, I've had clients in the past, say to me, well, I'm not too worried about it. One, because I'm not paying it out of pocket. It's coming out of they're rolling it into the mortgage. And two, if my house appreciates 2% year over year, it'll basically pay for itself. So there's a lot of different ways you can look at it, but just wanted to dive into that today. Just because I'm here to present information, the good, the bad, and the ugly. But I may not tell you what you want to hear, but I'll tell it to you straight. So you do need equity or a large down payment, especially now. Higher interest rate environments have created a situation where the banks won't lend as much money on these reverse mortgages because the interest rates are a little bit higher. So what that means, sorry, I just get a glass of water here. So what that means is that with the reverse mortgage, there's a sentiment that people with the reverse mortgage, they want to, the bank wants to take your house. They want to basically put you in a position where you go upside down on your property. That couldn't be further from the truth. If you go upside down on your property, the entity that loses in that situation is going to be the bank, because they're leaving money on the table, of course. Banks don't like to leave money on the table. So that's not their intention. Their intention is not to make you go upside down or something like that. So again, you do need equity or a large down payment. Minimum qualifications, residual income calculation. So basically, just need to make sure you pay your tax. You can pay your taxes, insurance, maintenance on the property. So if that calculation fails in regards to paying taxes and insurance and maintenance, then basically they'll require what they call a life expectancy set aside. So they're basically ensuring that your taxes and insurance will be paid, and they'll mandate that. So that can, I mean, it's a good thing, because then you're literally not required to make any type of housing payment each month. Now, the downside to that is that it will reduce the amount that they'll be able to lend to you, because a big portion of it will be taken up by your taxes and insurance, which in some cases isn't a terrible idea. Oh, I think we skipped one there. Let's see. Okay, there we go. So reverse mortgage information continued. The FHA administers most of the reverse mortgages. Whenever you hear the term HECM, that means that it's an FHA type program. And according to the U.S. Department of Housing and Urban Development, more than 500,000 households across the nation are using a HECM reverse mortgage. The amount of money available for a reverse mortgage is determined on the age of the youngest homeowner, the current interest rate, and the value of the home up to the maximum allowed lending limit. The index is based off of a monthly adjusted tied to the CMT. They used to go off of the LIBOR, but as Brexit happened, the LIBOR became more and more unreliable. So they moved to other ways to a different indice. So benefits of a reverse mortgage, you get to keep the title to your home, regardless of what your uncle tells you, that the bank is taking your house. No, that's not the truth. It's not even close to the truth. The truth is that it's a mortgage just like any other, and you still get to keep title to your home. So if you get a reverse mortgage and you sell it years down the line, you still get to collect the proceeds. You're not, and in many cases, it takes many, many years to go upside down on the property. Again, contrary to what you might hear from folks, but you would basically just take the proceeds. Basic credit and income qualifications come into play, just like we talked about. They just have to make sure that you can pay your taxes, your insurance, and maintenance on the property, and any bills that you have. Monthly payments are optional. So that's a misnomer that I think my industry doesn't do a very good job of, is letting people know that, yes, there is a monthly payment on the reverse mortgage. And if you wanted to make that monthly payment, not only would your home never go up, or your balance would never go up on the loan, but you could also pay the loan off if you wanted to as well. A lot of folks will, one of their concerns about this program is going upside down. Again, that's a big concern of the bank too, because they lose in that situation. But by going upside down, it's really a choice. Or if you have a large increase in your loan balance, again, it is a choice, because you can make a monthly payment with a reverse mortgage. It's just not required that you do. And what do 99% of people do when they get the reverse mortgage? They choose not to make that payment, because it does kind of defeat the purpose. One of the main reasons people do this program is so that they can avoid making that monthly mortgage payment out of pocket. They will basically have the house pay it for them. So for instance, if you have a $2,000 principal and interest payment on your house right now, and you want to retire, but you can't because you got to make that $2,000 payment, well, how about you put it into a reverse mortgage, convert it to a payment optional program? Then that $2,000, you can make the payment if you want, but you're not required to. So basically what would happen in that situation is that you'd have an extra $2,000 that you could either put in the bank account or use for whatever purposes you wanted, reinvest it. There's a ton of different things you can do with that. Let's move on here. So again, there's a lot of misinformation out there about this program, which is really the main reason why I've decided to do these reverse mortgage weeklies, is to educate people on this wonderful program that's changing people's lives every day. The two biggest myths I run into is that you lose title to the house. Again, couldn't be further from the truth. Basically, by doing the reverse mortgage, just like any other loan, you do have a lien on the property. Just like, forward mortgage, you have a lien. Do you technically own the house at that point? Yeah, you do. You could pull up the county records. It shows that you own the house, but it also shows that there's a lien attached to it. Same thing with a reverse. Second myth that I run into is that you're upside down on the property the day you take one out. Well, that's like the farmer planting all his crops and going out the next day and saying, "Hey, where's my yield at? Where's my crops?" It takes a really long time to go upside down. We really can't go very high on what they call your loan to value on the reverse mortgage. Generally anywhere from 35, these days 35 to 45% of the loan value. So again, you do need a lot of equity to do these. It's hard to talk about this program without talking about retirement in America. That's really one of the main reasons that I was attracted to this program, because of the financial planning tools that it possesses. So these are three buckets of income, three buckets of finance, basically. You have pre-retirement, you have your income. Most people are making money, then they're saving money, putting money into the yellow bucket here for their assets. And then they're also paying off their loan or paying off their mortgage on their home and creating equity in their home. Now, one of the biggest fears that most Americans have, or that a lot of my clients have, is running out of money prematurely. And it's a very, very big concern. People are living a little bit longer these days, and it creates a lot of concern about running out of cash. I mean, you could live to 70, you could live to 80, you could live to 90, you could live to 100. We just don't know. So the difference between 70 and 100, I mean, that's 30 years. So and if you really want to hear a lot about this, just pull up a seat next to a financial planner at the barbecue this weekend, and he'll talk your ear off, or he or she will talk your ear off about it, because right now running out of cash is a big concern. So financial planners are definitely trying to plan into the hundreds these days, especially if people are in good health, and will live a lot longer than they have previously. So this is just a state of affairs. This was a survey that was taken a few years ago. And at this time, 26% of Americans reported they had less than $1,000 saved for retirement. 26%. That's you put four people in a room, one of them has less than $1,000 saved for retirement. Again, going back to the pre-retirement buckets: income, assets, home equity. So these buckets change quite a bit after retirement. And that's one of the big reasons we talk about the reverse mortgage and financial planning, because of this system that we've kind of set up for ourselves here, especially here in the United States. A lot of people are saving, but the people who are saving are just not saving enough. So these buckets, the three buckets that we have here: income, assets, and home equity, they change pretty drastically in retirement. So the first bucket, as you can see, it's kind of shrunk a little bit. You're generally in retirement, you have a fixed income, so you don't have as much income that you were used to having when you were younger and working a lot longer. So what does that mean? Well, you have less money to put into the savings, the retirement here, and you're not paying off your home as much either. Well, if everything goes well and plan, you do the plans, and you're not part of that 26% that didn't save $1,000, save more than $1,000, then this bucket still becomes very important, again, because we don't know how long you're going to need it. And quite frankly, no one wants to run out of cash in retirement. I mean, it's a pretty scary thought to think that, you could be in your 80s or 90s and be dead broke. But that is the case for a lot of folks. I mean, millions of Americans are in that situation right now. And then if you paid your 30-year fixed on your mortgage, well, generally your home is paid off. You may not have a mortgage payment. You may have a lot of equity there. And equity is great to have, but the problem with equity is that it's not liquid. So, for instance, it's a lot like having a glass coffee table right there in the middle of your living room full of cash that you can't get to. So, if something were to happen with the car, or something medically were to happen, or something like that, and you needed to get to that cash, well, you wouldn't be able to unless you had like a line of credit pulled out, or you sold the property. And if you sell the property, especially nowadays, it begs the question, where do you go? Because rentals are, I don't know, here in Colorado, especially Denver metro area, I mean, my gosh, people are paying like $2,000, $2,200 for a one-bedroom studio. I mean, it is just insane how much rent has gone up, but that's really a reflection of the market. Supply and demand, there's a low supply, high demand, prices are going to raise. So generally, that bucket becomes vitally important because you don't know how long you're going to need it. And the last bucket there is generally just sitting there. The home equity is there. It's abundant, but the problem is you can't get to it. So again, here's the pre-retirement versus post-retirement. As you can see, the home equity becomes a big part of that because a lot of times you've paid off that mortgage. The savings becomes vitally important, as it is in the crown, your crown jewel here in the throne, because you need to hold on to that as long as you can, and the income does shrink. So the good thing about home equity right now is that things have increased over the years in regards to equity. So there's a lot of equity right now in properties. So let's talk a little bit about it. Well, what is equity? Well, equity is cash that is not accessible unless you sell or take out a loan and pay it back with interest. Does it really benefit you in retirement having a whole lot of equity? I cannot begin to tell you how many clients that we've worked with that were just struggling every single day just to get groceries, that had, eating bologna sandwiches every day, and, living in a house that they have free and clear that's worth $500,000-$600,000. I mean, but the problem is they can't get to that equity. So that's why they're turning to the reverse mortgage, is to access that equity and put it to use, because the equity is great to have, but it's just monopoly money if you're not able to access it. So is it better to pass on a higher net worth or more equity? That's a question that a lot of my clients ask themselves, because what if you're paying a $2,000 mortgage payment? What if you took that $2,000 and put it into some sort of vehicle, investment vehicle each month? Is it going to grow faster than your equity? Probably much faster right now. I mean, you got a high interest rate environment right now that we're in. So you have a lot of vehicles that are paying dividends right now, paying a lot. You're getting a lot of accumulation with these CDs and things like that. Whereas home values, they are increasing still, surprisingly, but they're not increasing at the same pace. So is it better to pass on a higher net worth or more equity? What do people usually do with the home that's bequeathed? I mean, if you want to pass on more equity, what's the first thing people do? Is they sell the property. And the reason they're selling the property is because they want the equity. They want the cash. They don't want the house. Very rarely will people take a home that's bequeathed to them and move into it or rent it out. Personally, I think it's a better idea to rent out, to create that passive income, to build wealth. But not everybody thinks that way. Not everybody wants to be a landlord. So, and then does cash do better in your pocket or locking it up in the home? So that's another question that folks would need to ask themselves, especially people who are considering purchasing a property cash. Let's say you got a $600,000 property and you have $600,000 cash. You don't want a mortgage payment. What do? Well, you put all that $600,000 cash into the transaction. You've accomplished your goal. You don't have a mortgage payment, but now you don't have that $600,000 cash. The minute you buy a house for cash, you lose all control over that money. You basically take that $600,000 and you hand it over to the hands. Put it in the hands of the bank, or do you put it in the hands of a buyer? It's no longer yours. You can't direct it. You can't control it. You can't do anything with it because it's gone now. It's in the property. It's locked up in that equity. And the reason I say you put it in the hands of a bank, well, if you want to get that $600,000 back out, well, you got to go to a bank. And then the bank dictates to you the terms that they're going to lend it to you on. Or you got to sell the property. And then the buyer says, yeah, I'll hand you back your $600,000. But then you don't have a place to live. So in my opinion, if you're about 55 or older, you should be using a reverse mortgage to purchase a property. Why? Because let's say that same $600,000, let's say we can lend on 50% of it. Well, you come to the table with 300,000. We come to the table with 300,000. And you still accomplish your goal of never having to pay a mortgage payment the rest of your life. The only difference is that now you got $300,000 cash in the bank. So you've become more liquid. Now with that $300,000, you can direct it. You can put it into different places. You have 100% control over that. You haven't handed it over to a bank or anything like that. So why are people taking these out? What are the benefits? Well, the first benefit is increased cash flow, optional payment or a tenured option. Asset protection, it's a great way to protect your assets. Basically, if you set up a line of credit with a reverse mortgage, I've got a lot of folks who own their home free and clear that'll do a reverse mortgage, mainly because they want to set up a line of credit that as a safety net for their assets. Also, it's a non-recourse loan as well. So you're never going to owe more on the property than what it's worth. Again, there's a sentiment out there that that I've heard from people who are, all opinions aside, they talk about how, the negative aspect of this program, the bank wants to take your house. They want you to go upside down. Well, guess who loses in that situation? The bank loses in that situation. Because if you go upside down on your home, this is a non-recourse loan. The bank can't come after you for that deficiency. So let's say a meteor hits the earth tomorrow. You take out a reverse mortgage and a meteor hits the earth and all the properties plummet like they did in 2008. Let's say you have a loan balance of $200,000 and your home's only worth $100,000. Well, at that point, if you sell your house at that point or you walk away from it, then the bank is going to end up taking that loss of $100,000. So that being a non-recourse loan provides a lot of those safety features that a lot of people wanted in these programs for years and years and years, and it finally got them in the last decade. So it doesn't require repayment until the last living borrower leaves the home, either by passing or selling, and the heirs have 6 months to decide what to do with the property. That's another misnomer. I had a very experienced real estate agent call me the other day and say, my client just called me. Her mother passed away. We're afraid to call the bank because it's a reverse mortgage and we don't want them to take the house. And I was thinking to myself, oh my gosh, you didn't pay attention in my class is what I was thinking, because with the reverse mortgage is probably the most friendly program. It is by far the most friendly program when it comes to that situation of someone passing or someone having to be moved to a facility. Because what they'll do is they'll give the heirs 6 months to determine what to do with the property, and then they can apply for 2 free 3-month periods. So they get a total of 12 months to determine what to do with the property. And on top of that, let's say just for some reason you are upside down. Let's take the example of you owing 200 and the house is worth 100. Well, at that point, the bank will actually sell the house back to the heirs for 95% of the appraised value. So the heirs would pick up that house that has a $200,000 mortgage balance on it. They would pick it up for $95,000. So, the sentiment that that this agent had about, the bank's going to take the house. We don't want the lender to know. It just doesn't make any sense. It's really just, creating this crisis off of information that is not based on any type of reality or truth. And it's also, again, a great way to purchase property, as I just mentioned in that previous segment there. So how are ways that you can unlock the equity in the house? Again, equity is great to have, but it's a lot like having that glass coffee table right there in the middle of your living room full of cash that you can't get to. Well, what the reverse mortgage does is just give you a little key so you can take the drawer out, pull the cash out when you want. Three ways that you can access cash. Number one, you can get a lump sum. So you can basically ask for a lump sum of cash, and a guy will show up in a trench coat with a briefcase attached to his hand there with a briefcase full of cash, unmarked bills, of course. No, I'm just kidding. But they'll just send you a wire, give you a lump sum. You can also get a line of credit. A lot of clients like that because of the two features that is very different from your traditional line of credit. One, you don't have a required monthly payment. So you take $50,000 out to go buy a boat. You don't have a monthly payment to pay that back. If you choose not to, if you want to pay it back, you want to pay it down, you can. You're just not required to. The other option with the line of credit is it grows in value every year. So you have access to more of that line of credit every year. So what that means is that you may have a line of credit that starts off at 20,000. In 5 years, you may be able to access 50,000. Now it grows on the amount that you have not accessed. And guess how it grows? What's the interest rate? Well, current rates. So people who have these line of credits right now on their reverse mortgage, well, in this high interest rate environment, they're getting 7-8% appreciation on these line of credits. So it's almost like having another savings account, because you're never going to be liable to pay more than what the house is worth. So let's say we really get into a rut with the housing market and you have a line of credit on your reverse mortgage, and you end up that line of credit, you may be able to access more cash on your house than what it's even worth. And then the last way that people can access cash on these programs is a monthly tenured payment. Basically like setting things up like somewhat like an annuity where you pay yourself back each month, or the house will pay you each month. A lot of people like to use that as, to bridge the gap from Medicare. Say you retire at 62, you can't sign up for Medicare until 65. So, you can pay yourself back each month until that sets up, or maybe you have an IRA or an annuity that's due, something like that. So common clients that we see, number one, we see people who are struggling with cash flow, that are retired, they're living on fixed incomes, and they want to basically convert that current mortgage payment into a payment optional program. Again, let's say your mortgage payment is $2,000 a month. Well, what would you do if overnight you were able to convert that into a payment optional program? Well, you just gave yourself a $2,000 raise each month. And that's a big, big deal for a lot of people. And number two, we see a lot of folks who are trying to use this as a financial planning tool, which it is great to use as, mainly because you can create that line of credit as a financial safety net for your assets so that you don't have to dip into your assets, and you can, pass that on to your heirs, or you can make sure that you ensure the survivability rate of those assets. Well, we're coming up on half of the hour here, so thanks everybody for joining us today. If you have questions for me, you can always reach me at any of our sites at chariotreverse.com. Once again, Zach Smith, chariotreverse.com. chariotreverse.com. Feel free to give me a call, or you can schedule time with me. We can schedule a Zoom call. Very happy to be of service. Hope you have a great rest of your day, and we'll chat with you next time. Thanks a lot.